Welcome to Chapter 9 in your Cornerstones textbook. In this chapter, we're going to focus on long-term liabilities. In other words, things that are owed by a company for a period of greater than 1 year. Now, we could have loans that are greater than 1 year, but this chapter, especially in the cornerstone problems, we're going to focus on something called bonds. Bonds are a type of long-term liability, but what they do is break down a really large debt amount, usually measured in the tens or hundreds of millions of dollars, into smaller chunks, often chunks of about $1,000 or so. So this is a way for a company to get a whole bunch of money, but from a lot of different individuals or entities, instead of having to find one entity that wants to loan 10 or $100 million. Now, the language of bonds is that we call the borrower, not the borrower usually, we call the borrower the issuer. Now, companies or governments actually can issue bonds, which are, again, these IOUs. The length of time that the bonds are outstanding is called the maturity. And so on the last day of the maturity, there is a due date in which all the principal is repaid. And we don't really call it principal when we're talking about bonds. We usually refer to the principal, which is the original amount that's borrowed. We call it the face value of the bond or the par value of the bond. The interest rate on bonds is called the coupon rate, and that's the interest rate that the bond issuer will pay to the bond holders for every annual period. Now, they actually usually break down that annual coupon payment into 2 per year. Every 6 months is how it usually goes. And a coupon payment is calculated by taking the face value or the par value of the bond times the coupon interest rate times the amount of time. So if it is paid in semi-annual payments, which is every 6 months, it would be the face value times the coupon interest rate times 6 divided by 12. In this example, we might have a bond with a $1,000 par value and a 10% coupon rate paid semi-annually, so we would come up with $50 every 6 months paid out as a coupon payment. Remember, it would be $100 a year, but if it's semi-annual interest payments, it would be $50 per payment. Now, just to remind yourself of some of the differences, when we're talking about bonds or we're talking about notes, which we did talk about in Chapter 8, the accounting treatment is absolutely the same. The vocabulary, however, is different. Notes, we usually refer to the original amount that's borrowed as the principal, then we have an interest rate, and we call them notes payable. But in bond world, we don't call it principal, we call it the face or the par value. The interest rate is not merely an interest rate, but is called the coupon rate, which results in a coupon payment, and we put them in an account, a liability account called bonds payable. Now, your book goes through various types of bonds, and just right here we show two of the most important distinctions, and that's between secured bonds and unsecured bonds. Secured bonds are secured by some sort of physical collateral, like a building or land. Unsecured bonds have no collateral. They are just a promise to pay, and they do rely on the reputation or the credit worthiness of the bond issuer. Now, how does a company sell bonds? Well, unlike getting a loan, where a company would shop around for a bank that wants to lend and find the best interest rate, when they issue bonds, it's far more complicated. A company needs to find an investment bank to underwrite the bonds. Then that bank goes out and finds thousands of investors who want to buy all those bonds at a good price. So we would generally say this is a more complicated procedure. It does result usually in the company's ability to get more money, but it is a lot more work. The selling price is usually a par value of $1,000 a bond. However, if a company sells the bonds for more than the par value, more than $1,000 per bond, we say that they sold at a premium, where the selling price was greater than par. And if the company is not able to achieve $1,000 or the par value for every bond it sells, whereas it sells below the par value, we say that that was a discount bond. Now, there's 3 main cash flows for long-term debt, especially in bonds. There's the issuance amount. That's the cash that's received when the bonds are issued. And it's going to be based on the selling price. There will be a debit to cash of the exact amount of money received on the sale. Then there will be a credit to bonds payable. The interest payments is any cash paid in coupon payments every 6 months or perhaps every year if it's an annual payment. So there'll be a credit to cash and a debit to interest expense. When the bond is actually repaid, there will be a repayment of the full face value of the bond, so that'll be a credit to cash and a debit to bonds payable so that we can clear the bonds payable. Let's start with an example, Cornerstone 9-1 in your textbook. We've got Groening Company, which issued $100,000 face value of bonds with a coupon rate of 8%. The bonds are due in 5 years, and the interest for our purposes in this problem is paid annually every December 31st. Now, of course, that's awfully convenient. It's not always quite that clean. But in this case, that's how we'll deal with it. So they have issued the bonds on December 31st, 2011. So let's record the selling of the bonds at par value. Par value means they sold at exactly the face value. So how much cash did they receive if they sold them for $100,000? Yeah, they received $100,000 in cash. And then now they have a liability because they owe this money 5 years from now. This is a long-term liability. So they would make a credit entry to show the new $100,000 liability in the bonds payable account. This is if those bonds were issued at par value or at the full face value of the bonds. And let's look at a different example. What if those bonds were issued at 103? Now that's bond language. What 103 means is that these bonds were issued and sold for 103% of their face value. Well, if face value is $100,000, what's 103% of $100,000? Right, it's $103,000. So if they had issued at 103, how much cash would they have received? Right, they got better than their face value in that sale, and so they received $103,000, and that would be a debit entry to cash. That means that they would have 2 credit entries. Remember, on the maturity date, 5 years from now, Groening Company will owe its bondholders $100,000, not $103,000, even though they got $103,000 when they sold them. They only owe the face value at maturity. So they only are entering into a liability of $100,000. But how do they account for that extra $3,000? Well, there are these accounts called valuation accounts that are liability accounts on a company's balance sheet. In this case, we have the premium on bonds payable account, and we will make a credit entry to that for $3,000, and that's how we get our journal entry to balance. We received, meaning a debit to cash of $103,000. There is a liability called bonds payable to the tune of $100,000 credit, and a $3,000 credit in the account premium on bonds payable. Let's look at the opposite situation. Groening Company actually issues these bonds on December 31st, but this time it issues them at 96. What that means is that Groening Company issued for a selling price of 96% of face value being $100,000, or again, the other word for that is par value of $100,000. So what is 96% of $100,000? It's $96,000, and that's the debit entry we're going to make to cash because that's how much Groening actually received. Now, we know that there is going to be a bonds payable liability because what Groening will actually owe, the actual liability will be $100,000, which is owed 5 years from now. So we know that there's a $4,000 difference here between our debits and our credits. We are going to make a debit entry to an account, a valuation account called the discount on bonds payable account. And that's going to be for $4,000. And we'll look at it all nice, neat, and clean right here. Now, how do we account for interest payments? Well, let's start with the easiest situation, and that's when bonds are issued at par value or at their face value. The coupon payments are the only interest associated with the bond. They will be equal payments every year. So the formula for figuring out coupon payments would be the principal amount times the coupon interest rate times the portion of the year for each interest payment. And that's often once every 6 months, so that portion of the year will be 6 divided by 12. So let's say on December 31st, Groening Company issued $100,000 face value bonds. The interest rate was 8%. They're due in 5 years, and interestingly enough, as we were looking in Cornerstone 9.1, it's the same in Cornerstone 9.2, that the interest is actually only paid annually. It's not paid every 6 months. So first, let's just figure out what is the interest payment paid on December 31st of each year. How would we figure that out? Well, we know that the interest payment is always going to be the principal times the coupon interest rate times the portion of the year. But in this case, is there any portion of a year that we have to deal with? No, because the interest is paid annually, so that portion of a year is just 1. So it's times 1, which we know is nothing. So $100,000 of principal times an 8% coupon interest rate means that every single year on December 31st, Groening Company makes an interest payment of $8,000. So for the years 2012 through 2016, what would the journal entry look like for those annual interest payments? Well, we know that every year for those 5 years on December 31st, the company will record the interest expense, which is going to be a debit of $8,000, and you know that the company is going to have to pay cash, which will be a credit of $8,000. And this will be for every single year, 2012 through 2016 on December 31st. Now we know that on December 31st, 2016, the company not only pays an $8,000 interest payment, but on that date, that's the maturity date. So that maturity date is when they pay back the face value. So they will clear their bonds payable account, that $100,000 of liability they've been hanging on to for 5 years, and they will credit their cash account for the full $100,000. This concludes the first video.